Francesca Battistelli, this could change everything. You're on Vision Christian Radio. It's Neil Johnson with you, the Tuesday edition of 2020, a conversation that could change everything. And for those who are not so used to a finance conversation, this time of year, just 10 days out from the end of financial year, you might want to hang on to some of the wisdom, as you'll hear today, as we talk about end of financial year and those sorts of things we might think about as families, as business people, as ones who are interested in what happens money-wise. So the end of financial year, just 10 days away, an opportunity today to access some wisdom from finance commentator Alex Cook. So 30th of June, fast approaching, tax time, investment strategies, issues around superannuation or in giving. Well, you might have a question or scenario to offer today, and it might be a blessing to lots more people than just you. So I'll just prepare you. In fact, we could open our talkback lines a little earlier. You might like to join into our conversation on 1800 316 316. So things like when government changes to regulations and policies affect your finances, well, you might be interested in some insights around those things. Are there any changes that are affecting you right now? Are there things that you might like to think of as even projections of what might be coming as you plan a strategy for the upcoming financial year? Well, Alex Cook is back with us, finance commentator and founder of Wealth with Purpose. Alex is a former stockbroker. He's been a successful financial planner, and he is the founder of Wealth with Purpose. His ministry is to help equip Christians to honour God with their finances by teaching sound financial skills. Our talkback line open on 1800 316 316 if you have a question or a scenario for Alex today. Alex Cook, a special welcome back to 2020.
Thanks, Neil. Great to be back again in the mad rush that is 30 June.
It is a busy time for you because while you do these finance commentary updates with us fairly regularly, you also have clients that you deal with not only in Australia but around the world. So, is it the same for others around the world? Are they working the same financial year as we do?
Most work on a calendar year, but certainly Australia is still good old 30 June, and that keeps me on my toes at this time of year and keeps me away.
Okay, so it means that you can actually you can divide busyness for 30th of June with busyness at the end of December. Hey, let me start with a listener question from Ellen from Goolwa in South Australia. She says, just have a few questions regarding investing some of my savings. I'm a recent widow and aged pensioner, also a Vision family member for almost 20 years. Good on you, Ellen. I currently have some savings through my bank, which are paying 3.85% monthly interest. To get this, I need to deposit $50 plus per month. Looking at their term deposit rates, which are 4.5%, without me needing to add $50, seems a better choice for some of my savings. Some of my family members have bought Bitcoin and gold bars and are very happy with the returns. I would really appreciate your thoughts on the above. Alex, what are your thoughts for Ellen as we get things underway?
Yeah, look, thank you, Ellen, for sending through your question. And it's a really important one because obviously a lot of people are thinking at this time, how do I maximize my returns, but also manage my risk? And so a couple of things that I want you to have a think about as you're mulling over what you should do. And the first thing we always start with is, what is your actual goal? What is it the purpose of this money? Is this for generating income, i.e. you need an income off the term deposits that you have in mind? Or is it because you're going to use this money in the short to medium term for capital expenditure? Maybe you need to buy a new car, or you need money for holidays, things like that. So what is the actual purpose of the goal? And then associated with that then becomes the time frame. So the way we always manage client money is based on when do they need that money back. And the longer the time frame, the more risk you can take. So if it's short term, as in the next 2 to 3 years, you want to keep that money ultra conservative. If it's longer time frame, then obviously you can afford to take a little bit more risk. So really the starting point is, what's my goal? What am I actually trying to use the money for? And therefore, how much risk should I take? And the second part to that risk discussion is what I call your risk profile. This is what financial planners talk to people about. And really the best way I can explain this is I call it the sleep at night test. How will you sleep at night knowing where your money is invested? So that's really important to keep in mind when you're investing money. You want to make sure you have peace about where it is and be comfortable that the money is secure and in things that you understand, which then leads to, of course, the big discussion around Bitcoin and gold. So Bitcoin's obviously taken a huge interest in people over the last few years, but my message here is one of extreme caution. Really, you've got to be really careful about allocating money to something like Bitcoin, predominantly because it's extraordinarily volatile. So to give you an idea, last year it lost 78% of its value. So you'd be very cautious about putting any money in there that you weren't happy to part with, because we just don't know the direction of Bitcoin. There's lots of pros and cons and arguments for and against it. So that's the first thing. Be very careful if you're going to dabble in things like that. Gold. Now, gold's a more interesting one because it's been around through the test of time. And I'll be honest, we do allocate small amounts of client portfolios into gold. It does have some downsides because it won't pay you an income. Unlike a term deposit, where you've got income at the moment, you get almost 5% in a term deposit. With gold, it doesn't give you any income, but it does give you that sort of security of sound money that's been around for 5,000 years. And so we always say to people, it does have its place in a portfolio, but not necessarily a large portion because it doesn't pay you anything, and it is also volatile. It goes up and down in value. So there's a couple of considerations, but obviously probably the big one that everyone's thinking about at the moment is inflation. We talk about the cost of living, but ultimately when you're investing money, the key to success is investing in things that are going to grow at rates that are equal to or greater than inflation over the long term. So that's the key. Invest in things that are going to beat inflation, which is difficult at this current point in time, but certainly that's the key when you're thinking about investing.
And thank you so much to Ellen in Goolwa for posing that question. And we're taking calls on 1800 316 316. I guess it could be one of those days. Sometimes we mention a disclaimer around the thought that insights are general in nature and you should seek advice from your own financial advisor. But you're welcome to call with a scenario and run those things by our special guest, Alex Cook. Let's take a call from Melanie in Victoria. Hi, Melanie. Welcome along.
Thank you. Just have a question based around HEX. I've heard that, I'm not sure the right words, but like the interest of HEX is increasing quite substantially. Our family still has one HEX debt. We own our own property and things. So I'm just wondering what the advice might be about whether we should actually pay off the remaining sum on the HEX.
Good question, Melanie, because there's some indexation that's happening on HEX debts. Thoughts here, Alex?
Yeah, look, thank you, Melanie. It's a great question, and it's one that's popped up a lot in the last 6 months. Normally, it's not talked about that much, but because of what's happening, that's changed. So normally HEX is it's a very cheap debt, right? In the sense that it really only goes up each year by inflation. Now, inflation's been very benign and very low for a very long period of time. But all of a sudden, as no surprise, inflation's jumped dramatically in the last 12 months. And as a result, HEX is going up by, I think, at least 7% this year. And so people are asking this question, should I pay it off? The first way to address this is, I think, if I listen to you correctly, you don't have a mortgage, in which case, if you've got no other debt, then you might want to start chipping away at HEX so that it doesn't grow, because you don't want it to keep growing and growing and growing. You want to actually pay it down as a general principle. In saying that, for anyone else with this same sort of question, because it is a common one now, generally what I say to people is you list your debts in order of their size, but also in order of the interest rate. So if your HEX debt costs you 7%, but your mortgage is costing you 8%, then you're better off paying off your mortgage. Likewise, your credit card's more like 18%. So typically you pay off the high interest rate ones first, because that's the one that's costing you the most, and you're throwing money at interest. So the key one is always the highest interest rate first. Now, there may be other considerations in that, but generally speaking, I would say to people, you really do want to chip away at your HECS debt and not let it continue to grow, particularly now that it's going to go up by 7% rather than the historic sort of between 1% and 3%. So it's a great question, Melanie.
Melanie, anything further to add?
I'm just wondering, does it also depend on your income level? Like we homeschool, we've only got one income. And so I think in the past I've been told that, yes, if you're below a certain income, then it's not necessarily... you probably can finish that off. I'm not really great at explaining
No, you're right. No, Melanie, you're right. So basically, it's a threshold when you have to start paying it back. So if you're below that threshold, and then it goes up in percentages. So the more you earn, the greater the percentage that you have to pay back. So if your income, say particularly the person who has the HECS debt is not working, then you're not actually having to repay any of it. So you're not obliged to pay it. However, as I say, what you don't want is it to keep growing 10 years down, large debt, hold can afford it. You just want to keep chipping away and paying it off and get rid of it as quick as you can, particularly if that's your only debt. As I say, if you've got other debts and it's a competition as to which one you pay off, because particularly if you are thinking about taking out another loan at some point, banks do look at the HECS debt and look at the percentage that you're forced to repay every year, because that will affect the serviceability of a loan. So you do need to take that into consideration going forward. But certainly, in my view, is you want to keep chipping away and get rid of it, even if you're below the threshold and you're not forced to. You don't want it to keep growing.
Melanie, thank you so much for your call. Our talkback line is open on 1-800-316-316. You might have a question, a comment, you might have a scenario for our special guest, Alex Cook. Let's take another call, Alex. Graham is in Queensland. Hello, Graham. Welcome.
Yeah, howdy there.
Graham, what are your thoughts? What's your question?
Well, I'm not sure if I think I'm on the right sort of questions. What I'm doing is I work out at Moranbah, but I actually come from Mackay, and I take my car out and back, etc. But I always take my tools back and that. And I'm wondering whether I'm being able to claim for the petrol money that way because I take my tools back.
Okay. Alex, thoughts? Graham, who works in Moranbah, lives in Mackay, and are there some tax benefits that he should be claiming around transport of tools?
Look, it's a good question. I probably can't answer it because it's actually more of the realm of an accountant. So financial planners, we tend to dabble more. We tend to dabble more in superannuation, investing, etc., insurance. It's a good question, and generally work-related expenses. So if the accountant were to deem it to be a work-related expense, then it may well be deductible. But it'd be very difficult for me to comment without knowing a bit more detail. And as I say, it's more of a question for an accountant. So I would look it up on the internet, see if there is any information about it. But also, if you have an accountant, reach out to them and give them a call, because tax deductions are really the realm of an accountant more than anybody else.
Graham in Queensland, thank you so much for your call. Our talkback line is open on 1-800-316-316. Alex Cook is our guest, founder of Wealth with Purpose. His ministry is to help equip Christians to honour God with their finances by teaching sound financial skills. You might have a scenario coming up to tax time. 1-800-316-316. We're back with more with Alex Cook in just a few moments. Alex Cook is our guest. He's the founder of Wealth with Purpose. Our talkback line is open on 1-800-316-316 and 10 days out from tax time. We've got the timing here so that if you hear something and you recognise there's something that could be of benefit to you around tax time, around your finances, around your plans for the new financial year, that there is a little bit of time to get those things in place. So our talkback line open, 1-800-316-316. We'll take some calls in just a few moments. Interesting as a family here, Alex. The thought that you and your spouse might well be talking about things in the lead up to the end of financial year. How important is it to actually include your kids in conversations around tax time too, especially perhaps if they're teenagers?
Look, I think it's a great opportunity. So I see this as a discipleship thing. The Bible has this wonderful passage in Proverbs that says, and many listeners will know it, start children off in the way they should go, and even when they are old, they will not turn from it, which I think is a great passage to encourage us with our kids, getting it right when they're young. And so when it comes to giving, which is really a core aspect of Christian living, we're called to be Christ-like. Jesus was the ultimate act of generosity on the cross. And so we want to teach our kids generosity. And the question is, how can you do it? And so one of the things, of course, that happens at 30 June is we all get emails and letters in the mail from various Christian organizations, doing their annual fundraisers. And so what I say to parents here is use this as an opportunity to sit down with the kids and actually talk them through the different organizations that you support or are thinking of supporting, and get their involvement, get their opinion, show them the brochure, show them the material so they can see that there's this world bigger than them, because, with young people, they tend to be obviously very, self-orientated. And so by showing them this, you're showing them the world, you're showing them what God is doing around the world, you're showing the importance of mission, the importance of helping the poor, and it's just a wonderful time to sit down with them. Now, obviously, they're not going to be involved in the financials of it. You're not going to necessarily tell them how much you're going to give to each and all that kind of decision, although you may include them in that if you really want to. But for most people, that's going to be a parental decision based on your budget. But the real issue here is getting their involvement and showing your heart to them about what you care about, what's important to you, and getting their input too, and getting their ideas. And that, to me, it's just a wonderful discipleship opportunity. And to sit down with your kids and have a chat about focusing on these eternal matters, because at the end of the day, giving is really about focusing on eternity and helping our kids to have that understanding.
Our talkback line is open on 1800 316 316. Let's take some more calls. Kate is in Queensland. Hi, Kate. Welcome along.
Good morning, guys.
What are your thoughts, Kate?
I'm just wondering, with superannuation and early access due to hardship circumstances, if there's only that one way of accessing it and then having to pay or forego around the 30% mark or whatever the current percentage is, if there's any other options in times of financial hardship circumstances, just so people aren't losing as much of their actual super.
Alex?
Yeah, so look, unfortunately, and we saw this during COVID, where the government basically opened up the floodgates and let people take money out during COVID, but normally it's fairly restrictive. So the terminology we use in the industry to access super is satisfying what we call a condition of release. Now, for most people, that's either things like reaching preservation age, which for most people is around 60 plus, or retiring, of course, which once again is beyond that. Then there is disablement. So if someone's disabled, they can access it, and that has to be permanent. And then the one you're talking about is hardship, and generally that's obviously limited. So it's usually an amount of about $10,000 that they limit it to. And it has to go through an approval process. So it is pretty restrictive, because ultimately the intent of super, of course, is around the long term. So it was never intended as that kind of vehicle. So unfortunately, it is pretty limited to what you've just, yourself mentioned, to those very limited early access rules. So there may be other options for you to consider around Centrelink and other aspects, but it's generally very difficult beyond that to get access to super.
Kate, anything further to add there?
No, I thought that might be the case. I was just asking just in case. Thank you for your time, Alex and Neil.
Kate, thank you so much for your call. Before we move on from that, though, that issue, there are disadvantages too, aren't there? Even if you have to access some of your superannuation because of hardship, you may be disadvantaging yourself long term. How do you see that, Alex?
Absolutely, because when we think of super as that long-term vehicle, it's really, you benefit from compounding. We talk about the magic of compound interest. So obviously, if you take money out in those early years, you're reducing your capital and therefore the income and investment return that it's generating. So by taking that money out, you can actually be wiping out years off your long-term return and a large amount of money off the table longer term. And that's why I think, that's why the government came under a bit of criticism during COVID for making it so easy to get access to. So yeah, just be very cautious. Treat super as a long-term thing. We always teach people, and Neil, you and I have talked about this before, about having emergency funds so that when tough times come, you've got other things to dip into rather than thinking about your super as a way of dipping into things.
Taking calls, 1-800 316 316. Let's hear from Andrew, who's in Moree in New South Wales. Hi, Andrew. Welcome along.
Good morning, Neil and Alex. It's good to talk to you this morning.
Good to talk to you. What are your thoughts here?
I was just wondering if Alex had any advice or thoughts on a church situation where I was just at a meeting the other night, and you look at, you might have X amount of funds in a fixed investment or just a higher interest rate account. When you're looking at that and seeing obviously the rate of inflation a lot higher than that, just wondering about any other ways that a church as such, obviously when you're dealing with other people's money, you have to be very careful and mindful. But I know if you have excess money, you could put it even into buildings and then get the rent permissions and so forth like that. But I don't know if you have any sort of strategies for even lesser amounts that churches could use.
Because, Alex, you do a lot of work with churches, don't you? So let's get some insights here for Andrew.
Yeah. Look, you've raised two really, really good points, right? The first one is the fact that it's donor money, and therefore you want to be cautious with it, right? Because everyone's, they've sown into the ministry, they've sown into their local church, and obviously they want to see that go to good works and so forth. And so you've got to obviously respect that as the leadership team. And so that's a big one, and you clearly point that out. But equally, there's this other big problem that we're all facing now, and that is that inflation's at 7% and you're getting 4.5% in the bank. So everything is negative in terms of its real rate of return. So I always bring it back to what is the actual objective of the money and what is the time frame of the money. So is that money needed in the next 12 months? In which case you really can't take any risk with it. You've got to keep it, very conservative. If the risk, if the time frame's longer, then you can then start to take a little bit of risk, and then the longer the time frame, the more risk is the general principle that we would apply to an individual. But you can with a church. But generally with a church, the main thing is often that money's used for, as you say, for missions or for buildings, in which case you generally don't want to take any capital risk. It's limiting your exposure to growth type assets at the moment. There are funds and things like that can give you like 6-7% at the moment with minimal risk, and so they do exist, but often have liquidity issues attached to them. You can't get ready access to the money in the way you can with a bank account and term deposit. So you have to look around, but as I say, begin with the objective, look at the time frame, and then ask how much risk can the church really take here, and that would generally for most churches be very minimal. So I hope that gives a bit of structure around the thinking rather than specific ideas, because that's tough at the moment, because ultimately most things are underperforming inflation, even shares in real estate, which are the good longer term assets that you would put money into to beat inflation in the longer run.
Andrew in Moree. And Andrew, while we've got you here, just to enlarge here, because it's a good thing for a church to have a financial position where they have some money that is spare and an investment. A lot of churches living week to week, month to month, and just keeping afloat, challenging times. There is something here, isn't there, that's important so far as the ordinary churchgoer who gives a contribution at their local church, a tithe or offering or some sort of financial contribution. This time of year, do you sort of reassess things, Alex? Is this a good time to be thinking about who actually is making decisions about finances in church? Sometimes you leave it in the hands of the pastor, sometimes as a eldership or some sort of a deacon's board or something like that. Hopefully people with some expertise on how to do this. A good time to reassess the way you do all of that financial management?
Oh, absolutely. And that should be a regular part of the leadership process, reassessing obviously who's making the decisions, but also, having that proper accountability in place so that risks, and so accountability amongst the leadership team, but also to the congregation themselves. I say that pastors are, when it comes to money, a lot of pastors will try and hand it over to the treasurer. And I always say to them, that's a mistake. The treasurer may be accountable for the numbers in the counting sense of the word, but in terms of the messaging and getting your message out to your members and about what the church is doing and why it's doing it, that really needs to come from the senior leader. To me, pastors are in the front line here and need to be the ones carrying the vision and associating the money with the vision of the church and what those funds are for.
Thank you so much to Andrew in Moree. Our talkback line is open on 1800 316 316. Just a couple of minutes out to news. Are there some important deadlines or cut-off dates that we need to be aware of coming up this end of financial year, Alex?
There certainly are. So for those listeners who are thinking about putting in last minute contributions into the super, obviously the obvious deadline is 30th of June if you need it to be recorded this financial year. However, what you should do is contact your super fund or jump on their website, and what you'll find is most of them will have their own deadlines for different types of payment, whether it's BPay, check, etc., or direct deposits. And the thing is, most of them close this Friday, the 23rd. Now, it may well be they'll still accept the contribution and recognise it even at the end of this week, but they just don't guarantee it. So the sooner you can get money in that you had intended to put in, the better you'll be, just to make sure it all happens comfortably and you've given yourself some wriggle room to get that money counted before 30 June.
Well, everyone's financial situation is different. You might have a scenario you'd like to run by Alex Cook. Alex, finance commentator, he's the founder of Wealth with Purpose, former stockbroker, successful financial planner. His ministry is to help equip Christians to honour God with their finances by teaching sound financial skills. Wealthwithpurpose.com is Alex's website. We're continuing our conversation after Vision National News. If you have a question or a scenario, give us a call. 1800 316 316. Alex Cook is our special guest. Good to have you with us. If you're just joining us, we're into an end of financial year conversation. You get to call the shots here. You might have your own question, comment or scenario around the end of financial year, what it means, and our talkback line is open on 1800 316 316. So end of financial year, just 10 days away, an opportunity to access some wisdom from finance commentator Alex Cook. So 30th of June, fast approaching. Tax time, investment strategies, issues around superannuation or around giving. You might have a question or a scenario. I mean, when government changes to regulations and policies affect your finances, you might be interested in financial insights. Alex Cook is founder of Wealth with Purpose, a former stockbroker. He's been a successful financial planner. He's the founder of Wealth with Purpose. His ministry is to help Christians like you or I to honour God with our finances by teaching sound financial skills. 1800 316 316. We'll take some more calls in just a few moments. Before we do, though, Alex, just let me come around Christian responsibility at tax time. I've heard it said, taxation is the cost of civilization. There's some ways, though, that as Christians, there's a spirituality to the way we think about government and taxation and those contributions we make. How do you see things for the Christian?
Yeah, you're absolutely right. And it puts a lot of our faith to test, in fact, our attitudes towards this kind of thing. So to me, the question here is, how do we glorify God in all that we do, and in particular, how we manage our money? To me, that's the overriding principle, glorifying God with the funds that we have. And so what are the biblical principles associated with taxation? Well, one that many will have heard of is the scripture that says, give to Caesar what is Caesar and give to God what is God's, which is when Jesus was asked about should they pay the temple tax, right? So that's the first one. The second one is, I think, around the idea of we have to do what's right in the eyes of God and what's right in the eyes of man. And so to me, really the key issue here is how do we honor God with our finances and obey the laws of the land? So that to me is the key things you want to do. Glorify God with your finances. And I think the issue here is, as you rightly said, it's part of our civil responsibility. You've got to pay taxes because that pays for hospitals, pays for roads, pays for a whole range of things that we often take for granted, and sometimes we treat them as rights when in fact they come at a price. And so we've got to remember that we have to contribute towards that. But to me, good stewardship does mean that you don't necessarily pay more than you have to. And so as a Christian, I should be diligent with my finances, and I should consider ways to legally minimize my taxation. There's nothing wrong with minimizing your tax so long as you're abiding by the laws of the nation. And that's a normal practice that accountants obviously encouraging people to do. But the main thing is you are obeying the laws and, not trying to find cute ways around it that would dishonor God. Particularly, you have to always ask the question, if someone found out about this beyond just the tax office, right? So it's not just the case of the ATO finding out, would other people find out about it? Would it bring the church into disrepute? And I think that's a really important thing to consider when you're thinking through these issues.
And I guess it's what makes Christian people good citizens, because avoidance might be crossing that line of breaking the law, but minimisation is in fact good stewardship because you are a steward of whatever finance God has given to you. Hey, 1-800-316-316. We're taking calls. Let's hear from Rose in Brisbane. Hello, Rose. Welcome along.
Good morning, Neil and Alex. I'm wondering if I need to start putting in a tax return again. I've been on a pension for quite a long time. I'm healed and delivered of all my problems, and I'll be getting back on my feet soon. But I am an over and above tithe payer, and I was gifted the family home last year as a transfer, and I do have some savings and therefore a bit of interest. So do I need to start putting in a tax return?
Good question. Alex, thoughts for Rose?
Yeah, so look, this is a question to talk to a tax agent about. So what I would encourage you to do is, I don't know if you've used an accountant in the past or a local tax agent, like ITP or one of those providers, and just basically go to them and say, look, this is my new situation now. So I've earned a certain amount of savings, I've earned a certain amount of interest, and they can talk you through the process of disclosing it to the tax office. So it's great that you're asking these questions. And so, as I say, talk to a local tax agent will be the best person to help you through that and disclose what's appropriate and what's necessary to the tax office as required.
Anything further to add there, Rose?
No, you've answered my question. Thank you very much.
Thank you for your call. 1-800-316-316. You might have a question, you might have a scenario. 1-800-316-316. Come back, Alex, to some of these responsibilities we might have, but even opportunities that we might have as Christian believers. When we talk about, taking advantage of tax deductions and such things, sometimes that's different for each individual. What are your thoughts here around a Christian approach to taking advantage of tax deductions?
Yeah, well, from a Christian point of view, obviously the key issue is finding what deductions apply to you and making sure, obviously, that they're genuine. And basically, there are lots of different categories here that people may want to look at. So, for example, work-related expenses is often a big one. So it may well be that a number of your work-related expenses are legitimately deductible. This is why, by the way, and just with the same with the last caller, should use a local tax agent. You don't necessarily need an accountant, but you do need someone who can advise you to take advantage of all the appropriate deductions that are legally available to you. So as I say, work-related expenses is one, self-education expenses, Charitable donations, now that's a very careful one you've got to be careful with, because some donations to certain organisations, like missions, for example, are generally not deductible, and other organisations, particularly benevolent things like that are helping the poor, generally are. So you just need to make sure that what you are claiming can in fact be claimed. Generally speaking, the organisation that you're donating to will actually say it on their form. Donations above $2 are deductible, so you usually know about it fairly readily. But just make a list of all your expenses and say, right, which of these are legitimately deductible, and talk to your tax agent about that so they can arrange that for you. So that's one really obvious area. The other area is around capital gains and capital losses. Many people listening will have investments, whether it's in superannuation or outside. If you have losses and you're wanting to get out of that particular investment, it may be an opportunity to take that loss prior to 30 June because losses get carried forward indefinitely and can be used and offset against future gains. Likewise, if there's an investment you're considering taking a profit on, you might not want to do it before 30 June. You might want to wait till 1 July. So you're deferring the tax liability out into the future. So it's not to say you're not paying the tax, it's just that you're deferring the liability. That's perfectly normal. It's just a case of timing the transaction. So there's often investment issues associated with tax, and this is a time to consider that. Once again, as Neil's indicated, ideally with getting advice from a professional just to make sure you're doing the right thing here.
Let's take another call. Kevin is in Armidale in New South Wales. Hi, Kevin. Welcome.
Good morning, gentlemen. How are you going?
Very well, Kevin. What's your question, or do you have a scenario for Alex?
Okay. We had a fundraising for a Christian organisation just recently, and we had people donate things to help raise the money. We had auctions and all that sort of stuff. But somebody said that as a sole trader that I could possibly claim the donations that I put in against my tax. But I didn't actually, all I gave them was a gift voucher to the value of, and the people auctioned to actually win that particular voucher. Is it possible to claim without any what's the word, paperwork?
Good question, Kevin. Thoughts here, Alex?
Yeah, so look, whilst it's a question for an accountant, to me, I'd be very nervous about trying to claim something like that whereby there's no paper record, because general rule of thumb is you need obviously a receipt for any deduction, any contributions you make. And secondly, it also relates to the organisation itself that's receiving the money. So if it's just a bit of a sort of ad hoc get together raising funds for a local thing, it might not necessarily be a legitimate, charitable institution with what they call a DGR status, so deductible gift recipient status, because those kind of structures are in place, are designed so that people can get tax deductions. So I would say if you haven't got paperwork, then probably not, and also that depends on the organisation that was the one receiving the money. So I chat to, once again, a tax agent and say, look, this is who I've given money to. Do you think I can claim this? But it's probably unlikely without any proper paper trail, and whether the organisation is in fact one that accepts tax deductible donations.
Kevin, while we've got you here, thoughts here, and this might be, again, the tax agent that answers this sort of question, Alex, but if you have given a gift voucher as a prize, isn't that something of a level of advertising and promotion that you may be able to claim as a deduction in your business?
It's a good question. I
just getting Alex's thoughts on it.
Yep.
It's a good question. I hadn't thought about it, to be honest, in the past, but yeah, it's a possibility. I'd have to think.
Okay.
I'd have to take that one off air and have a think about it.
Oh, good. Okay, thank you so much, Kevin. Great question. 1-800-316-316 if you have a question for Alex Cook. Alex, let's come back to one of those bread and butter things I guess everyone is concerned about around tax time, and that is superannuation. This is an area you are got significant expertise in, and a focus for people here. Are there real opportunities before tax time to do some special things with your superannuation? What are your thoughts here about extra contributions and such things?
Yeah, look, this is a really big area and a great opportunity for many people. Firstly, there are different types of contributions and they have different eligibility criteria. And so what I'll do is I'll give people the names of a couple of them, and then what I'd refer people to is the ATO website, where you can then look at the criteria and the eligibility rules, because that's really important here. And of course, Neil and I would both encourage anyone listening to seek financial advice before actioning anything that we actually talk about. You should really talk to a professional. But there's some really obvious ones. So potentially you can put money into super and claim a tax deduction. Okay, this is a contribution referred to as a concessional contribution, and there's an annual limit of $27,500 that you can put in and claim a tax deduction. Now, there are other elements that affect whether you can or not. So if you're listening to this and you're employed, maybe your employer's already putting in some money for you, then you have to take that into consideration. So for example, if your employer's put in $10,000, you might be able to put in only another $17,500 to get you up to that $27,500 limit. But the big attraction here is you can claim it as a tax deduction. So once again, you've got to know your limits, know what you've put in already, but it's an opportunity for many people that could take advantage of that. Another very common one is called spouse contributions, and that's where you deposit money into your spouse's super fund, but the spouse that makes the contribution gets a $540 tax rebate from the ATO. Now, the criteria for this is that the spouse who receives the money is earning less than 40 grand a year. Okay, so if you're earning more than that, this strategy won't work. So that's a good one. And the last one I'd bring attention to that many listeners may have heard of before is what's called the government co-contribution. And to get that, you need to put $1,000 into your super fund. As an after-tax contribution. So it's money you've already earned and paid tax on. You put it into super, and then once you do your tax return, the ATO will match it. They'll data match it, and they'll see that you've put the money in, and then they'll give you a $500 co-contribution. So it's a fantastic rate of return, 50% on your $1,000. But there is a criteria, and it works on thresholds. Now, the upper limit of that threshold this year's around 57K. So if you earn over that, you can stop listening because it won't apply. But if you're earning below that, then you're probably eligible for either a part or full government co-contribution. So that's just giving people a bit of a flavour of the different options that are available to them. But Neil, once again, I'd point people to the ATO website. Obviously, get financial advice is the obvious thing, but going to the ATO website will have the eligibility criteria for a lot of these things that we're talking about. Because what people need to realise is that if you make a mistake, sometimes there are tax penalties for over-contributing or doing things that you otherwise were not eligible to do. So just keep that in mind before you go putting extra money into super. And of course, the main one, though, is it's locked in. People keep it in mind, once you put money into super, it's locked in until you retire or reach preservation age, as we call it.
For a lot of people, our super is like set and forget. What's your thought here about how often you might actually get a review on this? I mean, you do it every year. I mean, I'm sure that you're going to say do it as often as you can. But if it just for a lot of people just goes on and on and on and, back to the super again. How often do you think, get together with your spouse, talk about your superannuation, maximise the opportunity that is there?
No, it's a great question. Look, I would say a minimum of once a year, because it's one of these things. A lot of people put it into the sort of, they think of it's in the back drawer and they kind of forget they even have super. In fact, I think there's billions of dollars in lost super that the ATO has on its books, and because people forget they've even got it. So to me, it's a case of taking personal responsibility and saying, right, I want to prepare for retirement, even if it's 30 years away. How do I do that? What's the right kind of fund? And just check on it every now and then. Make sure it's invested in the right kind of asset classes that's suitable for your age, and make sure you're taking advantage of the very legitimate opportunities that present themselves, such as the ones we've just talked about, like government co-contributions and spouse contributions. a lot of people get put off by the complexity of super, but at its grassroots level, it's really not that complicated. It's basically just a vehicle to provide for your retirement, and it's concessionally taxed. And there are a number of strategies to boost it and build it over time. And just review it regularly. As in once a year would be the minimum I'd suggest.
Okay, go once a year. Alex, other things that might be advantageous for listeners. Not everybody has the opportunity. If you're in the right job, you might be able to package your salary, doing something with the person who's in charge of the pay at your work. How do you actually do that? Is there some advantage in seeking out some opportunities there, end of financial year?
Look, absolutely. And a lot of this will depend on your employer. The most obvious one that Australians generally have access to from their employer, although their employer is not obliged to provide it, is salary sacrifice, particularly into superannuation. But if you're listening to this and maybe you work for a not-for-profit or you work for a government organisation, many of those get a certain portion of their income tax-free. So, for example, it's usually around $16,000 for not-for-profit organisations. And what that means is you can package certain things. So often you can package a car lease. Some will allow you to actually package mortgage repayments. So you're paying for your mortgage out of pre-tax income rather than net income, which is fantastic. So the key thing here that I would encourage all listeners is to talk to your employer, talk to the people in human resources, and ask them, what are the benefits and things that we are allowed to package under our employment arrangement? That's the question you want to have answer to, and then see what's legitimately available to you. It will depend on the type of employer you have, but certainly opportunities do exist for many Australians.
And I imagine that, some people working for some government departments, or there might be some businesses that have some special, incentive deals about how you can use your pay, your salary more effectively. I imagine you've got to check in with whatever your business is to see if there are some special things on offer that your boss actually will do for you.
Absolutely. As I say, a lot of employers are not legally obliged to provide many of these types of things. Many of them choose to do it because it's a very sensible retention strategy. They want to look after their staff, and so they make these things available. As I say, they may have limitations due to what's called fringe benefits tax. So if they're a normal corporate employer, if they give you certain benefits, they'll have to pay fringe benefits tax on it. And that's obviously a deterrent both for you and for them in providing those benefits. That's why, working for not-for-profits and government-related organisations can have some, seriously good financial advantages to them. Often they're perceived to be paying less, but when you allow for the benefits, sometimes they're actually paying very generously.
We'll squeeze in one more call. David is in Ballina in New South Wales. Hi, David. Welcome along.
Oh, hi, Neil. Hi, Alex. Just a question about transition into retirement. I turned 63 years ago, and I actually converted my super to what do they call that, transition retirement payment. I also had a bit of a part-time job. And since then, or 2 years ago, I got diagnosed with cancer and haven't been able to work. But I actually have come into a bit of money which I wanted to put back into my super because my transition to retirement's running out. Do I have to start another fund, or would the fund I'm with, which is Christian Super, would they allow that to add to that transition to retirement fund or not?
Alex?
Yeah, look, it's a great question, David. And so firstly, with the pension that's already in place, you typically can't add to it, right? So in other words, you can't add new money into that pension account. But good news is there's absolutely nothing stopping you from opening up a new account and putting new money into super. So that's easily doable. And then what you can do is then potentially merge that existing pension you have with that new account and then form and merge them into a brand new account effectively. So that's very common. So as I say, you can't specifically deposit into one that's already going, but you can open up A, a new account, and B, you can then merge them and start a whole fresh new pension as well if you wanted to. So the answer is yes, there's easy solutions to your to what you're saying.
David, thanks so much for your call, and time is running out. Lots of great detail and tackling an awful lot of different scenarios. And there might be some listeners who are thinking, oh, I wish my spouse had heard that, or I've got family members who should have heard this or that. Well, you'll be able to access this conversation a little later on this afternoon on a podcast, and you'll be able to send it on to family members or re-listen again to catch some of the finer points of what Alex was talking about. Alex is the founder of Wealth with Purpose, ministry to equip Christians to honour God with their finances, teaching sound financial skills. There's lots of free resources available through Alex's website, ebooks, the My Toolkits, there's free videos, there's podcast content, and there's some things that you'll be able to access and take advantage of. The website is wealthwithpurpose.com. You can also follow Alex on Facebook and on Twitter. There's an Ask Alex at wealthwithpurpose.com email as well. Alex Cook, we have run out of time today, but thanks so much for taking this opportunity and sharing these insights with listeners. I'm sure there'll be a lot of people who are thinking, yes, it's got our mind ticking over about the things we need to do before end of financial year. And great timing for our segment today, giving listeners 10 days to get things worked out before the 30th of June. Alex, thank you so much for being with us once again today on 2020.
Thanks, Neil. Always a pleasure. God bless.